Hey folks, Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So it's been a rough August and now September for stocks and also interest rates. Boy, the interest rates it's been something. I'll go to the charts first. We're looking at the Fannie 4.5% coupon. This was the price bottom back in June, ironically, when the Fed hiked rates by 75 basis points. It sparked a big rally. Then we had another hike, and we went 400 basis points in a matter of a few weeks. And one of the reminders here, as we go through what's been a very tough couple weeks, rallies and sell-offs get overcooked. Right? We dropped, we rebounded quickly. We dropped, we rebounded quickly. Now we're dropping hard, folks. This has been a one-way trade lower. We are due to find a bottom in price somewhere. We have to hope it's here. Right? These are the price lows. These are the highest rates in quite some time, and the highest rates in 2022. This area has to hold. Same thing, and when you look at the Treasury market, we're at 325, 326. We could go back up to test that, the mid 340s, 350, and that would be it. If you get above 350, things will get different in a hurry. But there's a lot of news, and there's a lot of things happening that are bond beneficiaries, and one being the rate hikes in and of themselves. We field many calls in MMG. What do you think the Fed's going to do? They're going to raise by 75 basis points right now at the end of the month. It'd be surprising if they do anything different because it's already been well telegraphed, and they're talking so tough, and they want to get to 4% on the Fed funds rate. And by doing so, by raising by 75 basis points right now, that means that the 10-year note, which is 10-year paper, right? It matures in 10 years, will have the same yield as an overnight rate, which is the Fed funds rate. And so that just shows how upside down the world is. And the only way long-term rates go higher from here is if the economy can absorb it. If the economy slows down so much that people can't take out an auto loan because it's tied to prime, which is obviously tied to the overnight rate, the Fed funds rate, or housing activity stalls, which is already stalled in a big way and in many, many ways. When you start to see that kind of slowdown and that demand is slowed, then rates have peaked. And so whether we're in a recession or near one, seeing the yield curve invert so much over the last month to month and a half tells us we're much closer to the peak. But this is a crazy, volatile, and uncertain time. And now we have the Fed back to jawboning, and we have to just wait until the next meeting. It almost can't come soon enough. I wish they could do 75 basis point today and just get it over with, and let's see how the market reacts. But this is what we're looking at technically. These are the price bottoms of the year, and we're approaching this important Fed action that's going to take place in a few weeks. And tomorrow we have the jobs report, and then we have a couple of inflation readings which will have a hand in what happens. I hope this finds you well. Have a terrific weekend. Next weekend on the docket, not a lot of news, short holiday week. So we'll go back to Fed and uncertainty. So have yourself a great Labor Day weekend. We'll talk to you soon. Bye for now.